Hey, this is Chris from Financial Modeling Education, and in today's video, I'm going to show you how I fit a private equity transaction all on one page. Now, this is an output page that I would normally have sitting at the top of my model where I'm pulling a bunch of information from an otherwise underlying detailed model, but this is the big picture info that you would need to send to a partner on whether or not to move forward with the deal. And so these are the high points that I typically include. First is just going to be the transaction assumptions. And so what is the purchase price of this company? What is that in terms of multiples of EBITDA? And then what is the latest EBITDA? So just big picture information on how we're getting to the purchase price. Then we have to know sources and uses. In other words, how are we actually going to pay for this company? And so we're going to talk through all the debt that we have to raise, then the corresponding equity that we have to raise to fill in the gaps. Because the uses are we have to pay for the business, so the cash goes to the seller. They probably have to pay down some debt. They may roll over some equity into the company, which basically means they get bought out and then they buy right back in. And then there's always a handful of fees on the deal, debt fees, diligence fees, fees to the sponsor, and even times some cash to the balance sheet. So this is the uses, and then we have to tell how we're going to pay for it. So this is what the partner wants to know: is how much equity are we going to have to call from our investors. And then from there, it's pretty high level summary information because we're talking about big picture, right? We just want to know, is this a fill or kill? Are we actually going to do this deal? So the income statement information, very summary level: revenue, gross profit, EBITDA, just the big things that they want to know. And then same idea with the balance sheet. If you're going to take on a bunch of debt up here to pay for the company, we're going to want to see how that debt unfolds over time. And so this is an LBO model, and you can see that the debt is getting chipped away at over time as we pay it down with free cash flow. And then so on the other side of the balance sheet, it's helpful to see what is the cash balance. And the reason that it's fairly low here in the future periods is, again, because we're using all the free cash to pay down as much debt as possible, because in an LBO setting we want to generate returns for the investors. So then down here at the bottom, summary statement of cash flows. Again, we're just showing the big picture section: cash from operations, investing and financing, as well as the change in cash and then the ending cash on the balance sheet. From a modeling perspective, you always want to make sure that this figure matches the balance sheet above, and you can see I have that little check to the balance sheet here. Might seem obvious, but it gets missed a lot. And then lastly, we have covenants and returns. This is one of the most important parts because the debt covenants are basically like financial health checks for the company. And are we going to be in compliance if we're going to borrow all of this debt to purchase the company? So that's part one. Are we going to be in compliance with our lenders? And then part two is the return to the equity, one of the most important parts, because if we're going to call equity from our investors, well, we need to know that we're going to generate a meaningful return for them, and then also ideally participate in some of the carried interest at the private equity level. And this is not going to be an attractive return for investors if we can't meaningfully exceed something that they can get in the free market, right? Because we're asking them to lock up their capital in an illiquid investment for several years, whereas the alternative is they just go to a brokerage account and earn 7 or 10% a year, something like that. So this is a very meaningful section to say, okay, do we feel like we can create meaningful operations in this company to generate these returns while also being in compliance with our covenants? And that's the thesis of the LBO model. Then over here, I'll have some handful of visual aids. This is just fake data for this presentation, but usually the net working capital is really helpful. Show the current assets, the current liabilities, and then the net working capital, how it moves over time. And then lastly, the covenants, always one of my favorites because it's just very clear: are we in compliance or not? Where the blue line is the covenant as specified by the lender, and the orange one is the covenant as calculated by the model. And so you can see these are both in compliance. So this is usually has a detailed LBO model underneath it, but not always. You can actually build a one-pager that looks just like this. You just have higher level assumptions about revenue growth, EBITDA growth, and working capital. It's usually off the print range, but it can actually be contained in a one-pager as well. Fortunately, I don't have a template like that anymore, but I did used to use it on the job. For this one in particular, I do have a more detailed underlying LBO model, but the point is you build your details in one place and you print in another, and you print in another. So basically, if I'm confident in my underlying model, then I can pull the details here and I know that everything works. And so that's how you condense everything from a detailed model into a one-pager. This is PDF friendly, so it's print friendly. I would send this along with a list of assumptions to the managing partner, and together we would decide whether or not to move forward with this deal. So that's it for this video. Thanks so much for watching. I will see you in the next one.